Well, good afternoon, and thank you for joining us for today's Manulife Business Success Series webinar on managing creditors 1 year into COVID. Important issue for all of our members and businesses. My name is Ian McLean, and I'm the President CEO of the Greater Kitchener-Waterloo Chamber of Commerce. Before we get started, I would like to take a moment to acknowledge that we do live and work on the traditional territory of the Neutral, Anishinaabe, and Haudenosaunee peoples, as we seek a renewed relationship based on a foundation of mutual understanding and respect. As participants in today's virtual event, we are coming together as one. We believe everyone is free to be their true self and receive the same respect and opportunity regardless of age, ethnicity, gender, culture, identity, sexual orientation, beliefs, or language. We hope you'll join us in fostering a positive environment here today that is a safe and welcoming space for all. We know there's more to do, and we are committed to listening, learning, and growing as we go. Today's session would not be possible without the continued support of our partners and sponsors. So a special thank you today to our title sponsor for the Business Success Series, Manulife, our platinum sponsor for the series, the Immigration Partnership of Waterloo Region, and to this month's presenting sponsor, Learners LLP. These organizations are committed to supporting our local economy and providing businesses with the resources and tools they need to thrive. Just before the session starts, I'd like to go over just a few quick points. Please ensure your microphone is muted throughout the presentation so we don't have any background noise. If you have any questions that come up throughout the session, you can type them into the question box in your control panel at any time. If it's tech related, a rep from the chamber will be back to you in just a few moments. And if they're for today's presenter, I'll aggregate those during the fireside chat and try and get as many of those questions answered as possible. All attendees will be sent a recording of today's presentation, and it will also be made available on the Greater KW Chamber website. I'd like to now welcome and invite Alicia Christian, partner with Learners LLP, to introduce today's speaker. Alicia.
Thank you, Ian. Learners is proud to be this month's presenting sponsor of the Business Success Series. I have the privilege of introducing today's speaker. Mike Braga is a chartered insolvency and restructuring professional with BDO Canada Limited, serving the Kitchener, Waterloo, and surrounding area. Since joining the Kitchener practice in June 2001, Mike has assisted a wide range of debtors, with his main area of practice being personal bankruptcy and consumer proposals. His high level of professionalism, combined with his empathetic approach, puts debtors at ease, facilitating difficult conversations. He assists with the corporate restructuring practice in the Kitchener office that involves court and privately appointed receiverships, proposals, and bankruptcies. As a partner within BDO, Mike has oversight responsibilities for the Kitchener-Waterloo region and surrounding areas. Most recently, Mike has launched Money Matters with Mike Braga, a community-based television show that leverages his contacts in the finance sector to provide his viewers with relevant and topical financial information. Over the years, Mike has been active with many literacy and educational initiatives in the community and sits on a number of boards. Please join me in welcoming Mike. I'll pass it back to Ian.
Thanks, Alicia, and appreciate, as we've said before, this partnership and the support of Learners in this series. So thanks so much. As we get started, Mike, and thank you for joining us today. These are important issues for our members, and frankly, we make this available through the Business Success Series to any business that wants to join in. We know that this has been a tough year for, in fact, most businesses. In one way, in every business has been affected in one way or the other. Some are doing okay from a business perspective, but still had disruption. Others are doing okay, but still have some challenges. And then there are those that are really, if you're front facing, that have had a lot of basically been shut down for the better part of a year, and are still struggling to keep going in what are, catastrophic circumstances. So it all kind of leads to, I guess, the first question, and we'll drill down on managing yourself through this period of time. So what's your sense of the financial outlook or the economic outlook for Waterloo region? I think that's a good place to start from, because while we're still in the grips of this, whatever wave it is, third or fourth wave, and we're back into lockdown, and many are struggling. kind of almost have to look and say, what do we see just over the horizon? Are in fact better days ahead? Because for struggling businesses, they got to make a decision every day. Do I hold on, and when's that brighter future coming? So what's your sense of the regional outlook and the economic outlook sort of in Southwestern Ontario?
Yeah, and if we start by looking at what's happened in the last 13 months, it really has been a tale of two pandemics. There's been certain industries that have been hit hard, as you can appreciate, but yet in our community specifically, there's been other industries that were able to pivot quite quickly and have actually thrived throughout the course of the last 13 months. We're very heavily invested into tech, and you know that many of the tech industries, they were able to start working from home almost immediately. There was very little disruption, and they're posting quite good returns for the 2020 fiscal year. And so, you know, that's really what's been happening. So when we look at the forecast for the region and when we start seeing those numbers come up, unless you start parceling it out, it may start to look like this is a very typical year. But it's that other side of the coin that we're dealing with today. It's those businesses that were really impacted and continue to be impacted by the uncertainty. And the uncertainty is going to continue for a while. And that's what we need to start keeping in mind, that really when we're forecasting, when we're doing business forecasting, we're no longer looking at 12 to 18 months out or, you know, the next 5 years. It almost has to be on a month-to-month basis because things are changing so quickly. And as you know, there's lockdowns that are occurring, then, you know, various levels of restrictions. And so we do need to start managing our business on a month-to-month basis. And it's going to be a matter of getting through this wave, getting everybody vaccinated, getting back to a sort of normal sense of normal, and seeing what the consumer behavior in the area is going to be. Because there's going to be some long-standing behavioral issues that we need to factor in. Are people going to be returning to restaurants and entertainment the way that they were 13 months ago, or is there still going to be some hesitancy even when restrictions are lifted? We don't know those answers, and you know, we have these projections that it's going to be the roaring 20s again because everybody is so cooped up and anxious to get out. But you know, we're going to have to wait and see, and unfortunately, that's probably not the answer that many of the participants or viewers that are listening to today's broadcast are wanting for. But I think that's the reality. It's going to be uncertain for a little while yet.
So as we think about that, because I think that's probably fair. I mean, I think that the general consensus is that at some point when we do get vaccinations and into more of, or certainly out of a lockdown, where we're starting to gradually see businesses open up, there is some pent up, I think, stimulus in the economy, meaning people have actually saved money. So we can see that there's likely to be, but how quickly, how fast, and where that money is going to be spent and which industries is the open question. And it really is, and it depends on where you're sitting as a business owner and your clients that may be having challenges or you're giving advice to about where they should be managing their business, depends on which sector they're in. I think that is more than anything less about the macro view of thing or 40,000 foot view than really what's on the ground.
Well, and consumer behavior is changing as well. So we were seeing in the last few years where the travel industry was booming and continuing to increase year after year. And over the last 2 years with the stay-at-home orders, people are investing more in their homes. And so does that mean, like, long-term that we are going to be more home-bodied? And again, there's going to be that reluctance to travel? We don't know. And that's where, you know, people need to start forecasting on those shorter timeframes because we don't know what the return is going to look like. We don't know what sectors are going to be coming back and roaring or what it's going to look like. So we have to prepare for all contingency plans.
So over the course, and we've done a lot of work and a lot with your colleagues, you know, over the course of this pandemic, on giving advice to folks on managing, whether it's through our Ask the Experts program and talking about the cash flow support programs federally, but also provincially and municipally. There's cash flow support programs, and many of those are. So there's a couple of ways I want to look at this. Many businesses, in fact, just about every business will have taken on additional debt. They will have got, some of it will have been maybe grants or non-repayable, if you will, but there will be, just about everyone will have taken on some measure of additional debt. Does it matter whether it's, you've taken on more from your bank or your creditors versus government loans or cash flow programs? Does it matter which ones, and how do you prioritize that? Because ultimately getting through this has been, where do you get the cash flow to sustain your business when you're not operating even at anywhere close to break even? So you're building this debt. Does it matter what type of debt you've taken?
It does. Let's unpack that question a couple of ways. So let's start off with, let's start off by answering the question, what should we do about that debt? And the first comment that I have is, for many small and medium-sized companies, they're really good about knowing what their burn rate is. So they know how much revenue they need to generate. That has changed. And so that burn rate, people don't look at that very frequently. And they don't build in, factors such as additional debt repayments frequently into that. We have to start doing that now. So for all of the business owners that are listening, that's the first thing we need to do is calculate what is the new burn rate and factor in debt repayment, regardless of where it came from. We have to factor in a debt repayment program into that. Because with the interest charges, what I wind up seeing is that the loans that you've taken on this year may not necessarily kill you this year, but it's the interest accumulation, it's the paying the minimums, not actually servicing that debt, that 5 to 10 years down the road. Eventually, if you bleed that dry, and all of a sudden, you're making some very different decisions. And so we need to start factoring in that debt repayment. And then, your second part of the question is, where should we focus? Again, I look at it from an interest rate perspective. We want to be, paying as little interest as possible and tackling the high interest rate loans first, in order to be able to again maximize our dollars. So that's one approach. The other thing we need to consider as well is, which is the most disruptive debt to be carrying. So if you are carrying a lot of Canada Revenue Agency debt, that's a problem, because Canada Revenue Agency, as we talk about later, has a lot of sweeping powers that they can arbitrarily decide to implement with little notice to you, and so again, we need to start prioritizing that debt. So I think if you are carrying a lot of Canada Revenue Agency debt, it's something that you do need to prioritize. Then it's high interest.
So let's deal with that, because there will be so there's a couple of times here, and I want to see if we can draw the distinction. If you already owe CRA, which is you've been assessed and through the tax system, that's one that sounds to me like that's at the top of the in bin. High interest, and it will be and they don't take kindly to not being paid. Do the cash flow support programs, and so some of these have been pushed out. As an example, the Canada Emergency Benefit, I think the CEBA loan program through the bank system, but it's still a government loan, effectively backed loan. Now I think they pushed that off into 2023. I'm sure that it's not repayable until 2023, and then there's a forgiveness element. Are those separate pieces that they keep distinct? Is CRA is one bucket, cash flow support programs are another. Then you've got, I would presume, you've got your bank and your other what we would say normal cash flow or banking things. Is that the way to kind of divide these things up, of saying which are the most urgent, or obviously by interest rate, but also by who can do the most damage to you? And I would say CRA is probably the one that could do the most damage to you.
Yeah, so absolutely, and so I would just reprioritize them to say it's your tax debt. So your source deductions, your HST, your corporate income tax. That's priorities. Those are priority one. Then it's going to be your bank debt where they have security on your assets. Because again, when you talk about business disruption, if you stop paying, if you stop paying that bank loan and they're appointing a receiver, putting you in special loans, or monitoring you quite heavily, that's going to be extremely disruptive. So that's the next line of priorities. And then after that, you're looking at what you're calling the income support programs that are being offered by the government. So that's how I would rank those three different categories for sure.
Okay, and I think with the cash flow support programs, because I think we spend a lot of time talking about that. I think what you're going to find is with experts like yourself and groups like the Canadian Chamber of Commerce, Ontario Chamber of Commerce, our Chamber of Commerce, will be going to the government and saying that crippling debt that people, to keep them alive, will probably mean there'll be advocacy of saying there needs to be more debt forgiveness on those cash flow support, or extending the period of repayment, because they just simply won't be able to service that when those timeframes come. Is that your sense of what's coming down the road?
That is my sense, and we need to keep in mind that there is that provision in those CEBA loans where, you know, there's that $10,000 or $20,000, depending on how much you've taken out, that is forgiven if you pay it back within the 3 years. I think these are going to be turning into long-standing loans that companies will have on their books for quite some time. Having said that, you know, that's not ideal for companies. So, you know, in all hopes they would get them paid off as quickly as possible, but I think, you know, from what we're anticipating is that these loans will be with businesses for a very long time, unless the government steps up and forgives a greater portion of them.
Well, I think you're going to find that business organizations like ours are going to say that's something that needs to be an investment in the future economic growth, is taking some of that debt off so business can invest in its own growth, because that's really the path out of the debt that's been created by government and for business, is that new jobs, new economic activity, and growing the economy. So we'll work on that together, Mike. We're going to put you on a committee and work with you and the folks at your shop on that, okay?
Absolutely. And it's important for the listeners to also appreciate that these programs, so sort of like the wage subsidies and the rent relief subsidies that the government are offering, they're still in existence, and you can still apply for it. You can even, you know, you can even apply for it retroactively. So if they haven't taken advantage of these various subsidies, now those are, again, they're a subsidy, not a repayment. You know, they're available, and it's important that they do take advantage of them. And so if you haven't yet applied for it and you think you might, and you've had a drop in revenue over the last 13 months, it's important that you avail yourselves of them.
And a good point, and we didn't pay you to suggest that people go to our joint website that the Cambridge Chamber and we have. Chambercheck.ca is a great place for anyone listening that hasn't, even if you haven't applied or don't know if you're eligible, go there. All of the programs federally and provincially are there with the criteria, and then feel free to come and ask us. We have a Ask the Expert, or folks like Mike or others can help direct you, because if you're eligible and you're not taking advantage of this on those especially those subsidy programs, which are effectively, I wouldn't say free money because we're all paying for it, but are ones that are government, you know, they're not loans. Let's describe it that way. You should be taking advantage of that. That's one of the ways you can manage your debt level and what's happened to your business over the last year.
Well, and a lot of people are in crisis mode, and so they're not necessarily in the right mindset to do the research. And so having the resources available where there is this checklist to make sure, you know, I might qualify, a one-stop shop is extremely important. So thank you for doing that work.
Okay, let's go. Just keep going with CRA, because as much as we love them, and I know accounting firms like yours, you deal with them all the time, and it's just part of life. They can be very disruptive in your personal or your business life. So, I think it's important to kind of put a bow or tie a bow on that issue of debt that you need to pay and in what order. If you're delinquent in paying CRA, they can do some things that would be very disruptive and damaging and potentially life altering to your business. So why don't you describe, you know, what they can do and how to try and avoid that?
Yeah, so I think, you know, and so not to alarm anybody. So if Canada Revenue Agency is thinking about taking these steps with respect to your company, the first thing you can anticipate is they're going to be sending out an auditor. And the auditor is looking for a variety of things. So they're looking at your books and records, number one, to identify assets. And why do they want to know what your assets are? Canada Revenue Agency has the potential to register liens on your assets, and again, with very little notice, right? So, you know, and where this comes into play is, and how we often see it is, you're plugging along, an audit has occurred, you've kind of not been able to pay the debt, so you're not ignoring it because you know you need to pay it, but you just haven't been able to. Well, all of a sudden it comes time to refinance, or you're trying to finance a new piece of equipment, and they go run the checks, and all of a sudden there's this CRA lien that's sitting out there, and all of a sudden you're not able to obtain the additional financing. So that's, for many business owners, that's the first time they hear about these liens. So it is quite, it becomes quite disruptive. The second piece is when you go to sell that particular asset, be it a piece of real estate or equipment, all of a sudden you need to deal with the loan, because any surplus cash that you might have already earmarked for something else, it's not going there anymore. It's going directly to the Canada Revenue Agency. So again, it's important to know that they can do that. The second thing that they're looking for when they're doing the audits is they're looking for your listing of accounts receivable. The Canada Revenue Agency can issue demands to your receivables saying, by the way, we now own this receivable, don't pay the company, pay us. And that's a quick collection remedy that they have to pay down the debt rather quickly. It kind of destroys the company because now all of a sudden they don't have a cash flow, but it's something that it's a power that they can initiate. They can seize bank accounts, and we see that a lot, and they can also make demands on individuals that have received draws from the company if those draws shouldn't have been, were inappropriately lodged. So there's a lot of ramifications, and for all of these reasons, we suggest you do need to be dealing with the Canada Revenue Agency.
Yeah, and I think, and I've heard this from some of your colleagues before, a good rule of thumb is if you know you owe them and they make any contact with you or appropriate contact with you that isn't a scam, not calling them back and not having that discussion with them, very bad idea. Right. They may not be the easiest group to deal with, but at least you start the conversation, bring in your accountant or your bookkeeper or others and try and work out something. I mean, that's the best course, I would presume, and that would be your advice as well?
It absolutely is, and the one piece of advice that I have for people, first and foremost, is file your returns on time, even if you owe. Two reasons for this. Number one, you're going to save on penalties. Like the late filing penalties are horrendous. They're 5% for the first month that you're late, plus 1% every month thereafter of your balance is due, so they accumulate quite rapidly. But the second reason that you're doing this is the Canada Revenue Agency is looking at this as an earmark to see if you're compliant. So if all of a sudden you've got 3 years of non-filed tax returns and you're on bended knee asking for a break on paying tax, they're not even going to deal with you until those amounts are due, and then they're going to be watching you on a hawk to make sure that any future amounts and future returns are filed. So it's best to take a proactive approach. File the return, pick up the phone and call them to say, hey, look, we're struggling right now, but here's the proposed payment plan. And they're more apt to work with you on that front as opposed to, cleaning up a mess. The other thing that business owners, tends to be the behavior from many business owners, and it's completely understandable, is from a tax perspective, they figure that they can deal with the Canada Revenue Agency later. They need to deal with their suppliers or other creditors first in order to keep the business operating. And so in doing that, they accumulate all of this tax debt. Again, given Canada Revenue Agency sweeping powers, you don't necessarily want to get into that habit, because again, that debt will accumulate, and then they have the ability to put an end to your business quite quickly.
Yeah, I think it falls into the category of don't get into an argument with a newspaper when they buy newsprint by the roll and ink by the barrel. It's the same thing with Revenue Canada. When they got all the tools, best not to think you can outsmart them, because you're never really going to win on that. So, okay.
Yeah, and just because, and to just put a bullet on this particular topic, just because the Canada Revenue Agency hasn't been aggressive in the last 13 months doesn't mean that they're not going to be in the future. So Canada Revenue Agency has different mandates, and the mandate from the government over the last 13 years is we need to get stimulus into the hands of our taxpayers and the people that need it. We need to keep the economy going. And so as a result, collections have been ramped down. At some point, the government is going to say, we need to collect tax dollars. Right? Yeah. We need to start paying for some of our programs, and collections are going to ramp up again. So do not take this, this little lull in collections as we're safe.
They haven't gone soft on you. They haven't gone soft.
They haven't. It's just a different mandate right now, and that is likely going to change, and probably by the end of the year.
Well, we've already seen some of that, Mike. We've seen you know, obviously with the CERB loan, and some folks think we're going to have to pay it back, and they backtracked on that since it was given in good faith. We're already seeing that with some of the loan programs for business where folks have been, you know, not sure you were eligible for it, and with, again, the best of intentions. So I'd be cautious of that, and I think you're right to see it ramped up. Okay, yeah. One of the programs that is that has been, you know, has been helpful, the second version of it being much more useful than the first, but was the rent relief program. I forget, the first one was called ICRA, I don't know what the second was called, but anyways, Rent 1 and Rent 2. The first version of it was very problematic. Landlords had to be part of that equation, and so many didn't qualify because the landlord didn't want to. And the second version has been much more, because it's really the tenant that can access that without having to deal with the landlord directly. But rent is a huge part of, obviously, wages and rent are the two pieces for any business, are usually the biggest two things, and then material. But so let's talk about dealing with landlords. You know, whether you owe them money, or, and I guess the other part of it is when your lease comes up, how do you negotiate to try and you know, get some benefit from. But let's start with if you still have some major creditor concern in how does your landlord relationship tie into that?
Yeah, and so, you know, and to put it in perspective, I think the national rate of vacant space is about 20%. Commercial space is right now 20%, and in the region it's a bit higher, it's at 30%, but that makes sense given the whole tech sector that we have here. And so again, there's going to be two different approaches. I think, you know, in approaching your landlord, we need to assess whether the landlord has been impacted by the pandemic as well. So many commercial landlords right now, they're looking at spaces where they're vacant, or there's been more vacancies because people have moved out. And so they may not be in a position themselves to provide a break or to negotiate on any kind of rent arrears. They may need it. They may need to collect as much as possible, you know. And so negotiating with the landlord right now is really tricky, because you don't know where they're coming from, and it's not a question you can ask either, right? So are they going to be reluctant to pull the pin? Well, it depends on what their financial circumstances is. And so that's why it's important to go in with as much facts and cash flow, your own cash flow set, and discuss any kind of negotiation with the landlord. Know what you can do and where you're coming from, and before you make that commitment, because what I'm finding is many people are committing to payment arrangements that it's just not realistic, and long term it's not going to be sustainable. So know where your company and where you're coming from before you enter into those negotiations, because you don't know what's going on the other side.
Well, I guess that's an important part. Is I think this is having that honest conversation with your partners. We talked about CRA, banks, others, but landlords, another one is we got into this in a great big hurry, but there's no one that's getting out of it in a great big hurry. And I think landlords that are probably wise in seeing that there will be an improvement, to be sure, but it probably won't be immediate in terms of vacancy rate. So working with someone who's prepared to say, yes, I know you, you know, a business owner that's saying, I know I owe you, but to your point, and working with your accounting professional like yourself, Mike, or your bookkeeper, saying, what is that? I think it comes back to that first thing you talked about. What's your burn rate? What's your revenues? What can you afford to do? And say, how do we stretch this out so that I can, you know, we can settle on an arrangement, but you can actually make those payments.
Now, business owners may be in a positive position because there aren't a whole lot of people looking to lease right now because it's just too uncertain. But having said that, I wouldn't be recommending that people go out and try to refinance or try to renegotiate their lease agreements at this point, trying to take advantage of it, because you just don't know. And so again, with that uncertainty, the conservative approach is always the wisest one.
But I do think the other part, and this is where you get advice from either your lawyer or your accountant, but when you do, when it is time to renew leases, I know there's lots of folks that are gonna, this pandemic would be one of those things that was not in insurance policies, it wasn't in lease agreements of saying, what if I'm shut down, as an example, by the government ordering me to shut down, right? I mean, that was, so you may see those types of things being at least tried to negotiate into lease agreements of saying, I can't be held liable if my revenue dries up to nothing because I'm ordered to shut down. So I think there's some things to file away for the when you do negotiate, and whether it's insurance or whether it's on your rent agreements, because no one anticipated that there would be a global pandemic,
Right.
that would last for, it's going to be 14, 15, 16 months before we're out of it. So that's it didn't happen for 100 years, but it might happen a lot sooner the next time if we're not careful. So.
Right. Well, and the one question that's coming up quite commonly right now, where it pertains to landlords, is what are their rights? What can they do to me if I'm in arrears? And so it's important to understand that in Ontario, there's two remedies that landlords have at their disposal. Termination, so essentially basically saying your lease is terminated, you need to get your stuff out by a particular date, is one of the remedies, and that's the most common that we're seeing. Distraint is the other remedy that they have, and that's where they do have the ability to actually seize assets with certain under certain provisions, and sell those assets in order to cover the rent arrears. Now, that doesn't terminate the lease, so that you would still have access to the premises, you would still be operating outside of it, and the remaining lease would still be ongoing, and that's why it's extremely rare. I think when you get to that situation where you're dealing with a tenant who's in arrears, you don't want to maintain that relationship. So termination is usually the route that most landlords will take. They can't just seize your assets without going through this legal process. So it's important that that occupants know that those are the two main remedies that landlords have at their disposal.
Okay, so moving on, the other important part, and this ties in with cash flow for most businesses, is bank funding as your prime source for most businesses, is your traditional banking partner. And of course, there's other folks like BDC and others that do tertiary or build on the traditional banking sector. But let's talk about bank funding. I think the general parts would be your general or your major creditor being your banker. How is borrowing? Like right now, interest rates are still at historic lows. There's some musings going on from the Bank of Canada and others that there is some inflation in the economy, and that, without going, I don't really understand it, but I can say these words of saying when inflation goes up, interest rates will likely fall to try and get that down. But what are you seeing on bank borrowing, or what's the firm's view on bank borrowing? Because that is another one of those carrying costs. If your debt load goes up by another percentage point on your bank loans or your banking debt, that could be really significant as well. What's your sense of bank borrowing as it relates for small and medium-sized business?
So what we're seeing in the region is that banks are continuing to lend. They're still taking their business-minded approach. So, I mean, there really there hasn't been a whole lot of change there, in that they're looking for strong business plans. They're looking for, the ability to weather the storm, and what your plans are in place. And if you meet their criteria based on having sound business principles, they're lending. But if you're in one of those sectors that has been highly impacted by the pandemic, so, your restaurants, your entertainment sector, trying to get bank borrowing or additional funds from a bank right now is going to be problematic, because we know that. So, I don't think their policies or procedures have changed a whole lot. It's just that there's large segments of the population, or large segments in large industries that are being impacted and don't have access anymore because of the impact of the pandemic. They're just not the same financial risk that they were 13 months ago. And so they're being scrutinized a lot more heavily. And so that's been the main shift that I've been seeing or noticing in the last 13 months.
So maybe, I mean, we probably should touch on, I know BDO, which is a sponsor of our radio show, Business to Business, that we air on with Greg DeRocher and I in the Cambridge Chamber, is part of our partners to keep us on the air. But so is BDC, and BDC is the Business Development Bank of Canada, which is Canada's bank that's just devoted to exclusively to entrepreneurs. I know that tagline, but that's another form of financing that people should start to take a look at, because they will lend in a way that some of your traditional bank might not.
Right.
Maybe touch on some of those things, because I think that's an important thing is it looking at all of your options and what types of debt you want to take on. Not speaking for BDC, but in terms of other types of, you got your traditional bank or your mainline bank, which is for most people would be their main bank account, but there's other banking instruments out there that should probably be explored, particularly now.
Right, and so as you go down those tiers, the main difference is the level of risk that they're willing to prepare, they're prepared to take on. But conversely, it also means how much more skin in the game do you need to put in as a business owner. So if we start with your traditional lenders like an RBC, CIBC, the main 5 banks, when you're going to them, they're going to be asking for a personal guarantee. They're going to be asking for security. Great. So and they're typically limited. Those guarantees are typically limited, more so. And so as a result, the amount of skin in the game that you have as a business owner or director is less. When you start getting into those secondary or tertiary lenders, they're looking for a greater guarantee from the director. So they're asking for personal guarantees, possibly mortgages on properties. Now, again, I'm not speaking specifically to the BDC. These are the secondary, tertiary lenders. And so they're taking on more risk, but they want to make sure that you're owning some of that risk as well. So, they're guaranteeing their loans very differently. And so it's important to keep that in mind, because when we incorporate a company or start our business, we're really good about getting that independent advice. So we're talking to our accountants, we're talking to our legal professionals, and one of the conversations, or many conversations that we're having at the outset, is how to creditor-proof a director. So how to make sure that as a director of a corporation, you're protected if something happens when the company is offside or can't continue, so that your personal assets aren't touched. What winds up happening when a company does get into this distressed situation is the director is doing everything that they can to keep the company going. They may not necessarily be speaking to their financial advisors or their legal counsel, and they're taking on additional loans with additional risk, and all of a sudden they're providing guarantees that are touching their personal assets. And a lot of that stuff where we set up that corporation to protect the director personally is kind of undone. And not unknowingly, but without having that specific discussion about, you understand what this means. And when we start doing that, we start doing cash flow projections and all that kind of stuff to say, okay, this additional financing you're taking on will get you through the next 6 to 8 months. What's going to change to make sure that the company is viable beyond that? And we start looking at viability assessments to make sure that the director is fully understands the risk that they're taking on before actually taking on those additional risks.
That's important. I mean, when we talk about directors, I mean, it's small business. It could be, you're taking that personal liability because you are the director. It really is the signatory. What are the signatories that have legal responsibility for your banking? You need to be asking those questions, right? That you describe about what risk are you taking on for additional personal assets, as an example, in a family-owned business or a personally owned business. It could go beyond the assets the bank already has. So asking those questions now makes sense.
Well, and we oftentimes we have those very tough conversations, which many people don't want to have, which is this business actually viable? And when you're speaking with an independent legal advice or with your accountant or professional, we're asking those questions of the director, not to be mean, but to make sure that you've actually had that assessment fairly, so you can make the appropriate business decision, because business owners and entrepreneurs are very optimistic. And realistically speaking, economies will bounce back. We know that, right? And it's just a matter of, are you going to be able to get there? Because the economy will rebound. It's going to boom again. It's just a matter of when. And in your business life cycle, can you get there?
Yeah, I guess that's an interesting. I spent the last 13 months spending a lot of time talking to politicians, but even more so bureaucrats who their sense of, well, a lot of businesses just weren't viable and should probably go out of business when they were trying to design programs, to which my reply is most small businesses are, it's a vocation. It's the job that they do. It's not to build a multinational. It's, I run pizza shop because that's what my family does, and it's where my family works, and it's where I work, and it's in my neighborhood, and I support myself, my family, my community. That's a different equation, because sometimes those financial ones, which are the important ones that you're highlighting, is even when that's your, I don't need to grow this to be a franchise of 20 pizza shops in Western Ontario, you still have to make that calculation of whether you can make the numbers work, and that's an important piece to go through.
Right, it's, it's that piece that I think the bureaucrats, as you're saying, and many of us that are in the large corporate world, we lose that distinction. We forget what it's like to be, grassroots and building a business and being, being hungry to build it for ourselves. Like, it's a piece of us, right? Because we're part of these, large multinationals. And so I think that's the piece that's missing in many of these conversations that we need to get back to.
Okay, and this falls into the uncomfortable situation, but I think it's a question we wanted to raise today, which is, there have been many businesses that have struggled. I don't think anyone anticipated we'd be into wave 3 or 4, whatever wave it is now, but it's certainly significant. It's really buckled the knees of a lot of businesses who we thought we were coming out of the winter wave and going to be opening up, and people have been holding on. And we've seen many businesses, unfortunately, have to close during the first 13 months. And those ones that have been hanging on, hoping for that recovery to start sooner rather than later, what are the options available for them? Is it all, you either all your chips in or all your chips out? What are some of those options to kind of either, say I can no longer operate, or I need to buy time, or, is there a sort of range of options that people should consider, and how would they evaluate what those options are?
Yeah, there is definitely many options available for individuals, and especially, if this is a conversation that you're having sooner rather than later with a professional, the more options that you have. And so certainly the first option that you alluded to is buying time, and that can take many forms, and we've already addressed many of them. So again, making sure that you're tapping into as much stimulus as possible, talking to your bank and potentially extending lines and all of that. And thirdly, when we're trying to assess it, it's having the conversations with your current lenders and suppliers, and seeing if you can't get some relief in terms of debt payments to get you through whatever period of time. That all hinges, like, again, if buy time is the strategy or the option that you're looking for, that all hinges on really good forecasting. So what I'm finding is business owners are really good about putting financial statements together to show me what's happened in the past, but predicting and forecasting what's going to happen in the future seems to be a major pain point for organizations of all sizes in all industries. And we need to get better at doing that, especially right now during these uncertain times. We need to know what our cash flows are going to be, and where we're anticipating paying. So if you're just buying time, forecasting becomes extremely important. There's another segment of the population, business owners, that are thinking right now, they're done, they're tired. It's been 13 months. They just want to get out. And so for many of them, preparing their business for sale is what they're looking for. And so looking at getting the resources of a professional to kind of figure out what their business is worth. So whether that's a chartered business valuator, or their account, again, becomes important, because we want to know what it's worth right now, and if you hold on a couple months, what could that value look like, and they can really assist you with preparing your business for sale. And then there's this third group of entrepreneurs and business owners that basically it's a shutdown that they're looking for, and there's multiple ways about doing that. And the orderly way, is to actually close your business, pay off your debts, and file the affidavit with the government. And that's one way of shutting down your business. And many organizations will do that. Others, they'll have debt, so they can't go through that orderly wind-up. And so a walkaway strategy for them is what they're doing, where they're just basically handing over their keys to the landlord and to the bank, saying, I can no longer operate, so you get to deal with the assets because they're secured. And they're dealing with only their personal guarantees, and they allow the chips fall where they may, because that's all that they can do. And we've seen that a lot with many restaurants or entertainment venues in the region have gone that way, where they've closed a lot of gyms, fitness facilities. They've just had to shutter their windows and turn over the keys because they just haven't been able to maintain it. So those are kind of the self-help. And then there's, the other way of closing a business where, the debts are unmanageable. So there's some free assets that need to be divvied up amongst the creditors, and the directors don't know where to turn to, and that's where the bankruptcy or restructuring options are available. And so, bankruptcy is certainly something that we anticipate will be increasing. With a lot of the stimulus that has occurred, many organizations haven't had to turn to that just yet, but all predictions are come the fall, bankruptcy rates in our region will certainly be on the increase.
Yeah. So maybe a related question, and I must admit, I probably know the answer if I really thought about it hard. But I'm interested in what's the difference between a receiver being appointed and going and bankruptcy trustee. I mean, is there a difference of that? Is that effectively the different professionals that are managing the two options that you talk about, which is kind of restructuring versus closing down?
No, they're fundamentally different. And I mean, unfortunately, receiver and trustee seem to have become interchangeable, but they're not. A receiver works on behalf of the bank. So a secured creditor is owed a bunch of money. They want to get their dollars back out of the business. So they go to court and they appoint a receiver who is going to realize all the assets and get them paid out. And so oftentimes we're dealing with just a few, like one or a few creditors exclusively to realize on their assets. Trustee in bankruptcy that's a liquidation. We're going in on behalf of all of the creditors. We're liquidating all of the assets of the business, and we're essentially shutting it down, disposing of the assets, paying the dollars out based on government schedules. And so, we're working on behalf of all of the creditors, not just the secured creditor in the court. That's the fundamental distinction between a receiver and a trustee. So they're very different. Many companies will go through a receivership depending on, how much they're owed to the bank and their value of their assets, and they'll come out the other side because the receiver will go in, realize on the assets they need to, or they'll get the secured creditor will get paid out. And the company is able to continue on business. That doesn't happen in a bankruptcy when a trustee is involved. We're liquidating. It's the end of a company.
So for a receiver, I guess that's an opportunity. They may be appointed by as an example, the bank to get their assets out. Does that mean 100 cents on the dollar? Or is that where the negotiation comes in of saying, what would you take in that circumstance? Because at the end of the day, presumably, I would think everyone would want to have, if there's a ongoing concern, that you don't intentionally, scuttle the business if it can come out the other side. But does that mean paying 100 cents on the dollar, or is that where sort of the receiver works with the business and works with the players involved to try and come to a resolution?
If you're wanting to maintain the business and operate it on the other side, it's going to be 100% plus the professional costs. Unfortunately, by the time a receiver gets appointed, the value of the business and the assets are so depleted that it's not even a viable option. And so that's where the warning signs are extremely important. Before a receiver is appointed, and well before, the bank has probably put you into special loans. And so that's a marker that many people often either just ignore or don't understand how serious that benchmark is. So if your loan gets transferred from the local branch to the special loans departments of the financial institution that you're dealing with, it's time to start getting some professional advice. Contact your lawyer, contact your accountant, contact a licensed insolvency trustee like myself so that we can start discussing things with you, because things can ramp up rather quickly when you are in special loans. This is a special group at the bank that only deals with these loans that are on the verge of teetering. Their job is to get those loans back on side as quickly as possible. But you know, again, it's that early warning sign when you're getting into that place that the bank may imminently be taking some additional steps. So it's important for you to know what you can do and where you're at before those steps start being put into place.
Listen, fascinating discussion, and while somewhat uncomfortable, I think business owners and entrepreneurs need to be armed with the information so they can make informed decisions. And there's a lot of folks that are, and COVID has done this right across the board, that are facing challenges. It doesn't mean we can't work through them, but having that information and knowing what your options are and what the best course is really important. So thank you. And I think where I would always leave it is, when you're facing these challenges, don't try and do it alone. That's why you pay lawyers and accountants and trustees, etc. Let's get some advice. It'll be the best that you have in order to, even if it means winding down, leave yourself the opportunity to wind back up when the time is right in the next venture. And that's partly dealing with your circumstance now in the right way. So that's great advice, and thanks for joining us today, Mike.
Thank you for having me.
All right, we've been want to just thank once again our sponsors for the series, Manulife. It was our title sponsor for the series. Our platinum sponsor for the series is the Immigration Partnership of Waterloo Region. This month's presenting sponsor is Learners LLP. And again, as I said before, thank you to Mike Braga of BDO. Thanks for joining us today. And finally, to all of you for joining us today. As a reminder, we do host a new Business Success Series session every Wednesday at 1 p.m. Join us next week for a discussion with Andy Taylor. He is the new CEO of Gore Mutual Insurance, and we're going to have a discussion, as he calls it, an 1839 startup that's now transforming itself during COVID-19. Great local story, how they're expanding nationally. Should be fascinating discussion to hear about the history here in the region of Waterloo and how it's now branched out across the country in growth, which is great. So for full details and to register, please visit greaterkwchamber.com. Please do share this series with your friends and colleagues. Join us every Wednesday afternoon for another edition of the Greater Kitchener-Waterloo Chamber of Commerce Business Success Series. Because if it's Wednesday, it's the Business Success Series. So stay positive, test negative. We're stronger together. See you next week.